When you're retired, you're free to do whatever you want because you no longer have to worry about employment and may spend your time as you like. You have the freedom to see the world, follow your passions, and even leave the city to spend time with your family in the country. As a stage in one's life cycle, retirement is marked by expenses related to meeting one's financial obligations and pursuing one's goals. So, starting early on retirement planning and avoiding the most common mistakes will help you enjoy your retirement to the fullest and be able to carry out your duties. What's up, everyone? I know it's too early to talk about it, but retirement is not something you plan when you're 40 or 50. You need to learn about it now so that you can enjoy your golden years to its fullest. So, if you're new here, this is Capital Finance, your go-to channel for business ideas, entrepreneurship, investment, and personal finance. It takes a lot of planning and hard work to make it to retirement with enough money to spare. The majority of people require years of savings and investment to achieve this goal. And even if done correctly, planning for retirement may be a marathon, and it might be challenging to fulfill your savings goals at times. So, here are some mistakes you must avoid when planning your retirement. The first mistake is not creating multiple sources of income. When it comes to early retirement, you'll need to do more than save your nest egg until it's ready. Then crack it open to paying for your post-work years. If you want to enjoy a comfortable retirement, you'll need to have numerous sources of income and stop relying on your investments or savings. Having more than one source of income has psychological advantages as well. You must also consider inflation when doing multiple resource planning because your pension isn't adjusted to it. Social Security benefits that you can claim early on are modified annually to cover the rising costs of Medicare due to inflation, while real estate and certain recession-resistant stocks are suitable investments because they keep the value of your money from depreciating even in the face of rising inflation. A larger payment of around 8% is available for each year that benefits are not claimed beyond the age of 62. And withdrawals from 401ks and IRAs are not permitted until 60. Otherwise, a 10% surcharge penalty will be applied to your drawers, reducing your income further and jeopardizing your retirement savings. Before you turn 60, your ideal early retirement strategy should include a variety of supplementary sources of income on which you may rely. Part-time jobs, stocks, bonds, taxable brokerage accounts, and other assets like real estate rents can all serve as sources of emergency funds. It's also possible that a significant amount of your retirement assets may be invested in stocks or other long-term growth possibilities, but the sequence of returns risk might have a disproportionate impact on your long-term investments. Thus, this strategy should only be used if the stocks in question have consistent performance history. Early retirees need to consider investing in low-cost mutual funds, or ETFs, even if most workers will automate their 401k savings. The second mistake is not considering additional healthcare costs. Employer-sponsored health insurance may be offered while you work, while Medicare will cover most of your healthcare needs when you retire at 65 or older. When you retire early, you may be confused about your health insurance alternatives because you fall somewhere between the employed and the retired. Unfortunately, the present uncertainty around health insurance does not make things any easier. To make the most of your early retirement, you'll want to consult with health insurance or financial advisor. If you have a spouse who is still employed after you have retired, it will also make sense to join their health insurance policies. Tax credits for reduced retirement income may include assets that can be used to offset premium costs under the Affordable Care Act's health insurance exchanges in each state. A different health insurance plan that charges a set monthly fee for all routine primary medical care services is known as direct primary care. Before entering early retirement, I urge you to purchase long-term health insurance because premiums increase as you get older. In the early years of retirement, when you are fit and active, don't spend too much on your health insurance rates. The implications of aging require that your health insurance plans pay off when you seek care and cannot depend on government policy Medicare as you become older. So your health insurance plans must pay off. Remember that even if you have a supplemental insurance and Medicare, you still have to pay deductibles, and there may be medical procedures that aren't covered. Eye specialists, dentists, and hearing aid services are not covered by Medicare. The third mistake is not managing your Social Security properly. As long as you wait as long as possible before claiming your Social Security payments, you risk damaging your ability to financially support yourself in retirement. Certainly, if you stay until you're older to collect these benefits, you'll earn more money each month. But this isn't always the best course of action. If you're working in a dangerous profession, you may want to begin collecting Social Security benefits sooner rather than later. If you start collecting benefits as soon as possible after retirement, you will have more money in your retirement years. Putting off applying for social assistance until later in life also means that if you don't live to the age of 80, you're wasting money that you can't get back. If you're considering taking your Social Security payments sooner rather than later, consider 3 scenarios. To take advantage of this benefit, you must be at least 61 years old and intend to use the funds in the early stages of retirement. When it comes to total income, your retirement account will likely be drained if you need to take out more than 5% of your next day's total to meet your needs. To avoid overdependence or depletion of savings before reaching 70, you need more significant Social Security income, despite the lower monthly payouts. The fourth mistake is not thinking of your dependents or children. More than 40% of elderly parents help their adult children financially in some form. The financial strain on the child of early retirees can be severe because their children are younger and more dependent. You may spend more than $1,000 a month after early retirement if you have more than one child to maintain. Early retirement plans can be less stressful if you include the financial needs of dependent children in the equation. Before you retire, talk to your children about what financial help they can anticipate from you, rather than cutting them off. Prepare your finances in advance by establishing ground rules with your children about how much and how long they can expect financial help from you. When you retire, you want to know that your finances will be secure. Early retirement preparation relies heavily on your sacrifices, your investments, and your Social Security retiree benefits. And don't let these retirement mistakes damage your financial security in your golden years. The fifth mistake is not planning at all. If you want to retire early, don't choose a random age and then work to save the necessary amount. To achieve early retirement, you must gradually reduce the amount of money you spend each month. You may ease into early retirement while continuing to work from home, part-time, or in a lower stress position by phasing out your career in stages. It will be much easier to bridge any psychological or financial gaps between the end of your job and full-time retirement if you make a gradual move into early retirement. Early retirement can help you get your mind off of the end of your working career and onto the idea of a full retirement sooner rather than later. To illustrate, consider a 45-year-old employee who wants to retire at 55 and earns $100,000 a year. They waited 5 years after being eligible to begin collecting Social Security benefits to ensure that their monthly payments would be large. An early retiree with a higher than average wage history might expect to take home approximately $31,000 in annual retirement benefits if they follow this plan. Until they became eligible for Social Security, the early retirees' assets would have been sufficient to meet their expenses if they had stopped their employment at age 55. Reducing the workload gradually and earning at least $50,000 per year from age 55 to 59 is the optimum strategy. As I mentioned before, planning for your retirement must start today if you want to enjoy your retirement years to the fullest. And that's it for this video, guys. If you like this content, make sure to click that like and subscribe button below, and I will see you in the next one.